Hello, friends. Recent geopolitical tensions in West Asia have triggered a broad-based correction across global markets. U.S. equities have pulled back, and commodities like gold and silver have turned volatile. This brings us to a key question. Is this correction a buying opportunity? From a valuation and historical perspective, the answer appears to be yes, but with measured risk. In this breakdown, I'll walk you through a hypothetical $1.2 million portfolio strategy and how I would think about allocating capital in the current environment. U.S. equities, 55 to 60% allocation. Let's start with equities. The S&P 500 is currently trading at a forward PE of around 19 to 20 times earnings. That's close to its 5-year average and well below recent peaks. What does that tell us? Valuations are no longer stretched. Earnings expectations have come down, and the market has reset some of its excess. Now, one important signal to watch here is market breadth. We're seeing more stocks hitting 52-week lows, broad-based selling across sectors. Historically, this kind of setup tends to happen toward the later stages of a correction. Where are the opportunities? Let's break it down by sectors. Financials stand out as a high-conviction play. Valuations are attractive, balance sheets are strong, and they benefit from long-term economic expansion. Real estate looks interesting as a cyclical opportunity. Prices have corrected meaningfully, and we're starting to see early signs of demand stabilizing. Industrials and infrastructure continue to offer structural growth supported by government spending and long-term investment cycles. And then there's consumer discretionary and autos. Demand is still holding up, and valuations have normalized after a strong run. Market cap strategy. There's also a case to be made for small caps. They've corrected more than large caps, and historically they tend to rebound strongly over a 2 to 3 year cycle. But keep in mind, higher return potential comes with higher volatility. Key risks to watch. No strategy is complete without risk. Continued capital outflows could pressure markets, and a broader macro slowdown could impact earnings. So while valuations are improving, the environment is still uncertain. Gold, 8 to 10% allocation. Now let's talk about gold. Gold has corrected roughly 10 to 15% from its recent highs. This has been driven by a stronger U.S. dollar, profit booking, and central bank activity. But structurally, the story hasn't changed. Gold still acts as a hedge against inflation, a hedge against uncertainty, and a strong diversifier in any portfolio. The strategy here is simple. Don't go all in at once. Use a systematic approach. Allocate gradually over time. 3. Silver, 5 to 8% allocation. Silver is a different story. It's part industrial metal, part speculative asset. On the positive side, demand from renewable energy is growing. Long-term supply constraints could support prices, but the risks are real. High volatility, sensitivity to macro factors like rates and the dollar. Price expectations vary widely, from $40 to even $300 in extreme scenarios. So this is not a core holding. This is a tactical, high-risk, high-reward allocation. Monotony. 4. Cash, the hidden asset. One often overlooked piece of the portfolio is cash. In uncertain markets, cash gives you flexibility, stability, and the ability to act when opportunities arise. Portfolio summary. So putting it all together, 55 to 60% in U.S. equities, 8 to 10% in gold, 5 to 8% in silver, and the rest in cash for flexibility. Final takeaway. Right now, markets are not showing signs of a systemic breakdown. Instead, this looks like a late-stage correction. For long-term investors, equities are becoming more attractive. Gold provides stability, and silver offers tactical upside. But this is not the time to go all in. This is the time for disciplined, phased allocation. Because in markets like these, It's not just about what you buy, it's about how you buy.